Hello, everyone. So I tried to prepare something that is simple yet extensive, and I consider that it's important for startups to build their financial model. And so the subjects, as Elvira was saying, we're going to cover all these today. It's not too extensive. It's 40 slides. I'm not going to spend more than a max minute by slide. If you have any questions, please, I'm ready to answer your questions at the end. And before the Q&A, there's a poll. I think Elvira will post a poll for your impression or what you liked about the webinar today. So the first question that I would like to answer is, what is financial modeling? Financial modeling is the process of creating a summary of a company's expenditures, so what you're spending and what you're earning, in the form of a spreadsheet that can be used to calculate the impact of a future event or decision that you want to take. That's going, okay. A financial model is also a quantification of your overall business, and it should be a reflection of your strategy, your business model, and your vision. So basically, whatever you're thinking needs to be reflected in the numbers that you are going to put in that financial model. A good financial model is a roadmap for your startup. It shows the different milestones you have in mind, the progress towards your target, and how you can adapt your operations to stay on track. So why is it important to build a financial model? Because I summarize it in three big parts. First, because you need to build an economically viable business. So you need the numbers to track your performance. You need also your financial model to inform yourself and your shareholders, or the people that have already funded you. And you need your financial model to be prepared for the fundraising process. So by quantifying your business plan, your mission and vision, you will be able to find out.
Your pencil. I think I saw it in the morning though. Where is it?
Elvira, can you mute them, please? Okay. So by quantifying your business plan, your mission and vision, you will be able to find out if you can turn your idea into a sustainable operating business. So with a financial model, you can run many scenarios. A financial plan will allow you to be transparent and clear towards your shareholders, generate easy reporting, and set targets and stick to them. Investors will ask you for a financial plan. So the financial plan will allow you to determine the funding you need, and it will also allow you to value your business. So what is the use of financial modeling? So with a financial model, a business can have a quantifiable view of its business activities, allocate business resources, set more accurate budgets for business projects, forecast the business future, test various scenarios, mitigate business risks, and estimate the value of the business. What are the different uses for financial modeling? So when you hear the word financial model, you hear other terminology because each terminology has its own use. For example, you can use a financial model to forecast. I will explain each one in a slide later on. You can use a financial model to budget. So forecasting is different than budgeting. You can use a financial model to be able to prepare projections And you can use a financial model to do some pro forma. So these are really different terms that you use them, and sometimes people use them interchangeably, but each one has its purpose, okay? So for example, if you want to forecast, it means a forecast is where the company is likely to be heading, whereby the forecast is generated based on your past performance. The budget is something you do on a monthly basis for a year to see how much money you have and how you're going to spend it over the year. And a projection is more answering the question, what would happen if? So a projection is not necessarily only based on historical data like the forecast, but it's more based on future performance. And a pro forma is exactly your financials as they are, but you change one thing to see what will be the impact. So let's talk more about forecasts. Forecasting, what it means, forecasting is based on, so how do you do forecasting? It's based on assumptions that estimates a company's future financial outcomes by examining historical data. Forecasting is used to determine how budgets should be allocated for future periods. Forecasting can be used for both short-term and long-term. Forecasts are used to update budgets. The team can take immediate actions based on the forecasted data. And forecasting shows where the company is heading in the future. Whereas budgets are plans for how much money should be spent on various items. Budgets cover a 12-month period. Budgets are broken down to weekly or monthly intervals. They are set for each department. For example, if you have the marketing department, you can do a budget for the marketing department. If you have a sales department, there's going to be a budget for that. And there's going to be a consolidated budget to consolidate the budgets for each department. So each department is typically should be given a budget limit, and they should work within that limit. And each department budget is then consolidated, as I said, in one budget. What about projection? So we talked about forecasts based on historical data that will allow you to take certain decisions. Budgets that based on how much money you have, how you're going to allocate it on each department and how you're going to consolidate it. And now we're going to talk about projections that answers the question, what would happen if? So projection is based on the desired outcomes and results a business hopes to achieve. The assumptions used in projection is based on hypothetical circumstances and not historical data. These projections are regardless of external factors such as market position, brand recognition, etc. So it's a what if scenario. Projection is used to answer what-if questions related to market, competition, business viability, and investment diversification. With a projection, a company sets desired outcomes such as expansion, growth, and what the founders hope to accomplish. And projection is your desired and ultimate course of action. So we talked about forecasts, budgets, projections, and now we're going to talk about pro forma. Pro forma, if you remember, I said it's about changing one variable in your financial model. So it's based on the current financial statements with one changed events. Let's say the taxation rate has been increased in the country. So what would be the effect on your financial statements if you change the tax rate, okay? Or if you change your gross margin, or if you change just one item. Pro forma focuses on the present and on the now. Pro forma is a tool that helps a company check the effect of one changed event. Pro forma are mostly used when you want to merge your business with another company and understand the synergies. For example, let's say you have two companies doing the same thing. You want to see how much sales are going to be and how much you can optimize costs. Proforma is used to see the effect of a big budget change, and proforma is used to finance or refinance your business and check its immediate effect on your finances. So all these are really ways of looking at your business and trying to see what would happen what if I change one item. How am I going to spend on a weekly and monthly basis? So these are just ways of planning your business and going forward with your business by looking at numbers instead of just looking at the strategy. It's really transforming your strategy, mission, and vision into numbers. So, what makes a good financial model? For me, it's like when you build a building, you need to have a good plan before you start constructing your business. For me, a financial model is a necessary blueprint before you do anything. Okay. A financial model is not something that you need to do very complicated, because you as a startup need to understand it, so it needs to be simple. It needs to be flexible. It means that when you develop it on Excel, the variables that need to be changed need to be linked. And when you link them, it will be easier when you want to change one variable. You can see the effect of it on the full financial statements without having to do a lot of alterations. And a good financial model shows you a clear cash flows. So basically everything you do when you build your financial model, to see at the end of the day, if the cash that you have at hand is going to be enough. Now, what are the different parts of a financial model? You should build a profit and loss statement, a balance sheet, and cash flow. I'm going to say this later, but don't think that if you build a profit and loss only, it's enough. No, you need a profit and loss, you need a balance sheet, and also you need to build a cash flow statement. A cash flow statement is just formulas that are derived from your profit and loss and balance sheet, but you need to see your cash flow, because the cash flow movement also gives you an idea about how your business is dynamically changing. So to build your profit and loss, you need to forecast or project your revenues, your direct cost or cost of goods sold, your operating expenses or your fixed expenses. You need to also see how you're going to fund your business, through equity or debt. So the debt comes from the balance sheet. The interest, you pay on it interest expense that is coming from the profit and loss. You also need working capital, and we're going to see every single item later on. You also need capital expenditure and the related depreciation, which is linked to both the balance sheet and the profit and loss. And the profit and loss is also linked to the balance sheet. So let's now look at the income statement. What's the purpose of income statement? First, the income statement or the profit and loss is the net income is equal to your revenues minus your expenses. Your expenses could be direct expenses, fixed expenses. Part of the fixed expenses, you can have personnel expenses. An income statement shows how much revenue a company earns over a period of time and reports all the outgoing during the same period of time. The purpose of an income statement is to focus on helping you quantify your costs and determine the right pricing and the sales volume. So sometimes you can be selling a lot, but you are losing money because the way you are pricing it, you're not taking into consideration certain costs, so you end up losing. So it's very important to understand how much you're pricing, how much volume you're selling, and what are the costs that are related, whether they are direct costs or fixed costs. So what are revenues? Revenues represent the total units sold multiplied by the determined price. What are direct costs or cost of goods sold? It's the cost that need to be made for a company to deliver a service or produce a good. So basically, let's say you are selling a toy or selling a computer. So different parts of a computer are the direct costs, okay? The people that are assembling this computer is a direct cost, but the person that is at the reception or the accounting person is a fixed cost. We're going to look at these in detail later on. The OPEX or the operating expense, these are the costs related to the supporting and operational side of the business, such as sales and marketing, research and development, and general and administrative expenses. Personnel represents the number of personnel multiplied with their costs, salaries, benefits, and related taxes. Revenues. Okay. So we understood that in an income statement, you have revenues, you have direct costs, you have fixed costs, and personnel costs. So revenues is the price per unit multiplied by the volume of sales. How do you forecast revenues? In order to forecast revenues, you need to be understood. Forecasting revenues need to be understood by business owners to be able to figure out how to price their products or services, how many products and services will they sell, how customers are going to pay for it, and how often customers are going to buy it. Use the bottom-up method for your short-term sales forecast and the top-down method for the long-term. We're going to see it in the next slides. If you cannot find market data on volumes, let's say you don't know, if you want to sell, let's say, computers, you don't know how many people are going to buy these computers from you. So you may use keyword searches in Google search criteria to determine the demand for your products and services. Pricing is based on market comparatives, as well as the cost of the production or the cost of bundling up the service you want to provide. What I mean here is that when you want to price a product, it's not only based on how is it priced in the market. You need to also look at your cost of production. If your cost of production is higher than what the price of the product is in the market, you either need to rethink what you are selling, or you need to look at the way on your cost structure. So it's really numbers do tell you if you are doing the right thing, or if you are producing efficiently, or if you are outside the market in terms of pricing or below the market. This is a snapshot of how I would put revenue assumptions. So I would put, for example, the units sold. I would put the average unit price, and I would get my revenues. Okay, so before we said that in order to determine volumes of revenue, we need to use either the bottom-up approach or the top-down approach. So let me explain what is the top-down approach. The top-down approach starts by you estimating your market size. What is your total addressable market? What is your serviceable addressable market? And what is your serviceable obtainable market? I'm going to explain this in the next slide. After you estimate your market size, you estimate also the number of competitors. After you do so, you analyze your strength for the long run. You estimate your market share for year 5, so how much you think you will reach in year 5. And you establish a revenue growth path. So let's look more in depth about how you determine your market size. So your total, what does it mean to determine the total available market? It means, let's say you want to sell, I'm going to use again the computers. So let's say you want to sell computers for the region. So you look at what are the available people, they depends on their age group, that are willing to buy computers. So the total, it is the total possible market for a company's product or service, the maximum possible revenue a startup can generate in each market, and it's the potential scalability. Then from the total available market, you see how much you can service out of it. What is the serviceable one? So the proportion of available market that best fit a company's product or service. So let's say your computers are for the age group between 20 and 28. So you look out of the total available market, how many people are from this age group. So you are formed from, these are formed, for example, from age group, geographical, regulatory, or price quality market difference within a total available market. And then you determine your serviceable obtainable market, which is the portion of the market the startup is realistically able to target. What does that mean? It means, let's say, if the serviceable available market is 10 million people, but your production cannot produce more than 100,000, so your serviceable obtainable market is 100,000. It cannot go more unless you have to pay more or invest more. So we talked already about the top-down approach. Oh, and I forgot to tell you, please avoid assumptions like 1% market share. It doesn't, because let's say the serviceable available market is 10 million, okay? Let's say 1% of that is way higher than your capacity. Therefore, you cannot put it as a market share in your financial model, because it doesn't reflect your capacity, and you might have to put more cost in order to produce that much. So you have to be as realistic as possible. Okay, so what are the advantages and disadvantages of using the top-down approach in determining your revenue volume, the volume of revenue? So it has advantages when you start from the total market and you reach to the obtainable market. First one, it's quick, it's easy if you know your market. Two, it will allow you to have better financial control. And the third one, it gives you financial accountability. You know how much your money will be spent. However, you would be tempted to take a random market share because sometimes data is not available. Your forecast can be also too optimistic, especially in sales. And you might be potentially underperforming because you have been too optimistic in your assumptions. So if there is a top-down approach, but there is also a bottom-up approach in determining your revenue item. How do you do it? First, you start from the first year of revenue forecast. Let's say you had a minimum viable product and you decided, you started selling, and you have seen or tested the market a little bit. So you have an idea of how much, based on your capacity, you are able to generate revenue. So you start from there. Then you estimate your customer acquisition cost. So you estimate how much if I want to increase my revenue, how much is going to cost me for every customer I'm going to bring in? Then you have to estimate your conversion rate, the number of purchasers divided by number of visitors. So you have an e-commerce website. You know that if you put marketing $1,000, you will get 500 visitors. And then the 500 visitors, how many of them will be able to buy from you? This is your estimated conversion rate. And then based on all these metrics, then you are able to determine your budget, the volume, and then you can project customer growth. So that's the bottom-up approach. Again, what are the advantages and disadvantages of this approach to determine revenues? First, the advantage is that it's really, really detailed, okay? It is less dependent on external factors because it's based on real data and real cost structure. The projection is made based on the main value drivers of your business. So what are the disadvantages? This method might fail to show the optimism needed to convince your potential funders. This method might not be appealing to investors, and it's time consuming. So maybe it's not really economically beneficial for you to go that deep, especially that sometimes you do not have that much of special data. So what do? I personally advise on a hybrid approach, which is I take the top-down approach, I forecast my top-down approach, I forecast my bottom-up approach, and I use the hybrid approach. Why? Because I use the bottom-up method for my short-term forecast for the first 2 years to demonstrate real short-term targets. And then I use the TAM, SAM, SOM, the top-down method, for the longer term in order to demonstrate to my investor that if I start like this the first 2 years, I can go for the next 3 to 5 years. What is my ambition? How am I going to realize my vision and my mission? So let's take an example. I have spent a little bit of slides on revenue because for me, revenue is really the key driver of a financial model. Everything else will be derived from what the market and how much you're expected to sell, okay? So let's take Airbnb example. In their 2008 pitch deck, I've extracted what they have assumed to be their TAM, their SAM, and their SOM. So they assumed, they know that worldwide the trips that are booked are 1.9 billion plus number of trips. They know also that the budget and online trips represents 532 million of this 1.9 billion. And they also know that Airbnb, based on their cost and based on their capacity, that they can take 10.6 million out of these 532 million. So how did they transform this volume into a forecasted revenue? Well, they said the expected number of trips that we are going to assume in our business is 10.6 on an average rate of $20. And we are expected to have a revenue of 200 million for the period 2008-2011. Now, let's look at the direct costs. Direct costs is the cost per unit multiplied by the assumed volume that we have derived from the top-down and bottom-up approach, the volume of sales. Direct costs help you produce your goods or services. And I'm talking about direct cost compared to fixed cost, which we are going to talk about later. So what are the direct costs? They can be the physical materials that are needed to make your product. They can be servers that you need to power your e-commerce website. So this is a direct cost, it's a variable cost. They can be the salaries or commission you pay to the employees to produce and sell your products. And they can also be the transportation or the delivery that you get your product to the consumer, because that's really based on, it's a variable cost. So it goes up and down depending on how much you are selling. So this is also a snapshot of how I do my cost assumption. So you see here, I have direct product cost, advertising and marketing under my direct, shipping fees, marketplace fees. These are really variable costs, because marketplace fees, I think some of you would know that they would take a percentage of your sales. So as such, it's a variable cost. But the fixed portion of it would be under the fixed cost. So let me give you some examples of each type of variable cost. So physical material. If you are selling computers, you'll need to factor in the materials needed for the screen, the keyboard, and the hard drive, as well as any other material needed to build the device when designating a cost for it. If you hire any freelancers or contractors, you also want to factor in how much money you will need to spend on their labor. So every time a salesperson also sells a unit of your product, he or she is paid a commission. So that's considered a variable or a direct cost. Every website needs a server. So the servers needed to store customer data on your product, particularly if your product is in the form of a software, is a direct cost to your business. Moreover, data center space you rent or own to store those servers is a direct cost. Why? Because the more your number of customers increase, the more this cost is going to increase. It's not a fixed cost. Once a customer buys a product, how will it get to them? Will it come in the mail, or will it be a delivery tech from your company, a delivery technician from your company will bring it? Or you will need to determine which strategy you will use and add up the costs associated with that delivery. Power, sometimes electricity, can be considered a variable cost. Usually it is a fixed or an indirect cost. However, you may account portion of the power used for activities that change depending on the volume of activity. Now, let's talk about fixed costs. So we already determined how we determine revenues, how we determine what are our direct costs depending on the type of business. And now let's look at our fixed costs. To what goes under direct cost before, it's beneficial to understand what is listed under the fixed cost or operating expenses of your business. OPEX usually includes incurred by your company, whether the company is generating revenue or not. So if you want to keep your company operating without, let's say, generating zero revenue, these costs are going to be paid anyway. Let's see some examples. It includes rent. So whether you sell or you don't sell, and you have rented a space, you have to continue paying rent. You have to continue paying utilities. Salaries of, not the direct one we talked about, but salaries of the employees you have. Office supplies, maintenance, repairs, property taxes, professional fees like legal and audit, insurance, etc. OPEX can also include expenses such as marketing, as long as the marketing incurred by the company is a general marketing fee. Okay, it's based on a retainer, for example, and not aimed at specific sale of a product or service. So this is, for example, a list of operating expenses. Now, why did I separate personnel from operating expenses? Because I believe that when you forecast your financial model, or when you want to project it or anything like that, sometimes personnel is overseen. You cannot, when you do a financial model, put the people you already have today. You need to have a vision of what will be your ultimate structure and put all these people and see and put them in phases. Let's say, well, today I'm going to have one person for these departments, but when I'm going to grow, I would need that much. And this will affect your cost. And the more you are conservative and the more you put the real cost, the more you are going human resources costs that you would need in your company. It's also important to understand the taxes, the benefits, the medical insurance, and other requirements in the country. Let's look at an example of a typical commerce startup organization chart. So you have the founder, HR, customer service, logistics, finance, IT, and legal. You also have the merchandising department, marketing department, and operation. So under merchandising, you should have people that look at the buyers and the producers. You should have people taking care of your inventory, the people that are the analysts that looks at the replenishment, the photography, copywriters, online merchandising. In your marketing, you need to have somebody in charge of customer acquisition, branding, design, customer retention, program managers, social media. And in your operation, you need to have a product or a project manager, a system administration, and web developers. Now, so we looked at revenue, direct cost, fixed costs. What are other elements that you can find in your income or profit and loss statement? You have other revenues and expenses, depreciation and amortization, and taxes. So what are the other revenues and expenses? Other revenues, they can include the revenues that are not at the core of your business. And you're gonna see a very funny example by Airbnb, how they raised their first funds by revenues, not related to their business, but they use them to finance their startup. Other expenses are expenses that do not relate to a company's main business. The company needs, for example, to pay some interest expense if they took a loan, or they might have losses from disposal of fixed assets. Now, if you buy a server, or if you buy a desk, if you buy a laptop, everything has to be depreciated. So depreciation indicates the value reduction of assets a company owns. So what is depreciation? It's the cost divided by its life. So let's say you buy a computer or a laptop, it has a 5-year life, okay? So let's say it's $600, $500, you divide it by 5, so you depreciate it for $100 a year over 5 years. It means after 5 years, you would have had a non-cash item of total buy again that laptop. Taxes, so every company that is registered has to pay income tax. And this really depends on the country where you are incorporating your company, but this is inevitable. So we talked about the whole profit and loss statement. And this is what it should look like as a summary. So as you see, the gross profit margin is your total revenues minus your total direct cost. Your earnings before depreciation, interest, and tax is equal to your gross profits minus your OPEX. And finally, your net profits are equal to EBITDA minus depreciation, minus interest expense, minus tax. Okay, so basically, we've talked about revenues. We've talked about how you determine your revenues and how you find your volume of sales, expected sales, and how you price your products. We talked about what goes under direct cost and how you price them. We talked about fixed cost, and we talked about other items such as depreciation, such as taxation, and other revenues. And this is what your P&L should typically look like. Now, once we've talked about the income statement, it's important now to talk about the balance sheet. So what's the purpose? What's the balance sheet? It's the assets, which are equal to your liabilities and plus your owner's equity. So a balance sheet, it's a business statement. So don't think that if you've done your P&L, it's enough. You need to know what do you need to buy, okay, as assets in order to finance your business, and who's going to finance it, whether it's going to be liabilities, debt, or equity. So a balance sheet is a business statement that shows what the business owns, what it owes, and the value of the owner's investment in the business at a specific point in time. So the income statement is over a period of time, so it's over 1 year or 1 month or 1 quarter. The balance sheet is at a specific point in time. So in order to start a business or to initiate a new activity, investments in assets are required. Therefore, you need to quantify these investments. Similarly, in order to invest in assets and pay for the cost listed before, you need also to fund those payments. Where you're going to get the money from, either external funding in the form of capital or loan. So what are the components of a balance sheet? You have the current assets and the fixed assets on the asset side. Current assets are the resources owned by your startup that can be sold or used in the short term. Your fixed assets are resources owned by your startup that have an economic value and that can yield a future revenue. So if you sell them, you might get money for them. So these are also called capital expenditures or CapEx. So your assets are either financed by liability or equity. Liabilities represent the debt of your startup to fund various business operations. Your startup can have short-term or long-term liabilities. And the equity is what the owners can claim once the debt is repaid. So let's say you're selling your business, you sell the assets, you pay your liabilities, and what is left is the equity. So let's look at it in more details. Because when you look at it in the details that I'm showing it to you, you will understand every single item and how you're going to go and find it and put it for your startup. So on the total assets, what do you have? You have current assets that can be cash. Accounts receivables means that when you give a bill to a client and he hasn't paid it yet, you are waiting to receive the money from your client. Inventory, so what you have. So basically what you've sold and what remains is your inventory. Prepaid expenses, so there are things that you've already prepaid, but you haven't gotten, you didn't yet give the service of it. And then you have, out of the total assets, you have current assets and you have fixed or long-term assets. These can be financial investment. Let's say you invested in a stock or it can be property, plant, and equipment. So it can be, you can invest by a building, an equipment, a laptop. And there also can be, when you invest in the intellectual property right, when you register your idea, it's an intangible asset, something you cannot, you know, it's intangible. So, but you register it because it becomes a name, has a value, and this value is an asset to you. So your total assets are equal to your, as I said, liabilities plus equities. So what do you have under liabilities? You have current liabilities. So you have accounts payables. So basically when you pay a bill, okay, so when you pay, when you have to pay a bill, you get a bill, but you haven't paid it yet. So it's a payable. So you owe it to the, let's say you have to, I don't know, pay to your auditor. It's a payable. An accrued liability means that you have signed a contract and you know that you have to pay it at the end of the year. So you accrue the payment and you divide it over time. You say you have to pay it. Short-term debt, okay. And then you have the long-term liability. It can be long-term debt, deferred tax, lease liabilities, and end of service indemnities for your employees. So every employee you have, as per law, you need to put a sum at the end of which they get it when, or the government gets it, depending on the laws of the country. So your total assets are equal to total liabilities plus equity, owner's equity. What's under owner's equity? There's the share capital, which is in the form of capital, could be a shareholder's loan, could be a convertible loan. These are different forms of equity. And under owner's equity, there is the retained earnings or losses. So all the net profits that you have accumulated and you haven't used are here, or if you have losses, these are accumulated here, and less if you distribute dividends. So this is taken out of your owner's equity. So liability and equity is funding. Accounts receivable, inventory, prepaid expenses, minus the payables, accrued liability, and short-term debt are called net working capital, okay? So, and I'm gonna explain the next slide, what does working capital mean? And these financial investments, property, plant, intangible assets are capital expenditures. So let's look at the net working capital. Why am I calling it net working capital? Because it does not include the cash. The cash is the result. It's what you have at the end. So your net working capital is your current assets, excluding the cash, minus your current liability. Your working capital is the capital that you need in order to sustain your daily operation. So basically, this is a very important item you need to know. So you know if at the end of the month you're going to have enough money to pay salaries or to pay your bills. And let's say if you don't manage well your client and you're not getting the money from your client at the right time, you're not going to have enough money to pay your dues. So that's why we call it a working capital. It is the money you need to pay your bills and the money you should receive from your customers following a sale. So how do you assume how much you should have as accounts receivables in your financial model? Usually it's a percentage of sales. Inventory is a percentage of your cost of goods sold, and prepaid expenses are a percentage of your sales, and all of these are the percentage of your cost of goods sold. But now if you come and ask me how much should be that percentage, that is going to be based on the best practice in the market where you are. Okay, so there is going to be a certain level of research, for example, and there is a standard norm. Let's say Certain suppliers pay after you can pay them over 90 days. So you have 3 months. It's like a short-term debt. Some clients, you agree with them. Let's say you're doing a website for a client, they pay you 50% now, and then they pay you 25 and 25. So that's also a receivable. So all these really have to be really properly assumed and as realistically as possible, so that you don't really find yourself without cash at the end of the period. So this is why collection of your bills from your customers is important. Sometimes you need to hire somebody just for that. And paying your bills in a smart way as well is also, with facilities from your supplier, is also important, so that you don't find yourself in a squeeze at the end of the period. Now, let's look at capital expenditures. Capital expenditures are funds used by the company to acquire, upgrade, and maintain your physical assets, such as property, plant, building, technology, etc. It's important to identify the assets that your company needs to acquire in order to launch your business and or specific project, for example, such as an e-commerce business. And these assets should be depreciated. So let's look at the business model canvas of Airbnb. Okay, so what are the capital expenditures that they needed? They needed to develop a platform, so that's an asset. They need to have an infrastructure cost, so that's an asset. So this is something that they can sell, a physical thing. The development of their application is important. Now, a maintenance is a cost, so it goes in the direct cost or the fixed cost in your income statement. Sales and marketing also, it's an expense. It's not a capital expenditure. Legal and administrative costs, it's a fixed cost. It's not a capital expenditure. So I wanted to show you that there is a difference between capital expenditure and expenses. So again, capital expenditure is something you buy, but that you can sell afterwards. Now, we discussed assets. Now we need to discuss funding. So how are you going to fund the assets that you have acquired? So funding is the money needed to launch a new business. It can come from a variety of sources and can be used for any purpose that helps the startup go from idea to actual business. So how can you fund your business? Either debt or equity. So funding can also be determined after determining your expenses and fixed assets. So how do you know how much money do you need? After you have done your analysis, you have done your top-down and bottom-up approach, you have forecasted your revenue, you have seen how much is going to cost you in direct cost, how much you need as fixed cost, and how much assets you need to buy, and then you will see how much funding do you need. Or you can reverse engineer it and say, well, I have that much capital, I can start selling that much, it's going to cost me that much, I need assets that much. So you can go either way. So let's look here at, I love Airbnb. So let's look at Airbnb and their funding at different parts. So in their first serious funding, the price per share was $0.01, okay? And the value of the company was $615,000. Okay, and then now today, the company is valued at $31 billion. So the price per share is $52.50. So it jumped from 0.01 to 52.5. So you don't start with a big company and it's big, it has a big value, but you grow over time. And what I wanted to show you is that funding is not a straight line. So you can start with bootstrapping and cost efficiency. So I wanted to show how Airbnb started. They actually sold cereals in the number of locations where they have, and they raised $30,000, okay, in the beginning from selling serials, okay? So they funded, they initially funded themselves. And their real first funding came from the Y Combinator Accelerator, and it was $20,000. Okay, and then they got this serial thing, which was $30,000. And then along the way, they got rejected by famous VCs. And then they got a seed round. So it's not really a straight line. So if I get my first grant, then I'm going to get my second and third. So all I wanted to tell you that a company that is worth $31 billion today, it wasn't really a straight line how they got their funding. Now, we've talked about the balance sheet, and this is what a balance sheet looks like. Assets are equal to liabilities plus owner's equity, and we've discussed each one, the fixed assets, the depreciation, the current assets between receivables, inventory that we can call stock. Now we're going to talk later about the cash flow. And then you
Hello. It seems we lost Randa. Let's wait for her a bit.
Randa, you're on mute.
okay. Okay, hello. Can you tell me where you reach so I can continue? Cash flows? Hello? Can somebody tell me where you've reached?
Go back one slide, please.
This one, the cash flow, or this one? This one?
We finished
that one.
Okay, very good. Cool. Okay, so now I was saying that you shouldn't ignore the cash flow statement. So investors are going to ask you for the three statements, the P&L, the balance sheet, and the cash flow, because each one is going to tell them a different story about your business. And all three of them are going to give them a full picture of your business. So what is a cash flow statement? It's the cash from operation, cash from investment activities, and cash flow from financing, plus the beginning cash balance will have the ending cash balance. A cash flow statement is the lifeblood of an entity. It's a business, cannot survive without cash. It is cash that pays the bills, not the profits. This is why do not, as a startup, ignore to build your cash flow statements. Your decision-making process will be easier when you are able to prioritize cash outflows and plan for cash inflows. And most importantly, investors do want to look at your startup cash position alongside your profit and loss statement and your balance sheet. So you start with an opening cash balance. You have your cash flow from operation, cash flow from investing, cash flow from financing, and the ending cash flow. The cash flow from operation indicates the amount of money your company brings in from its ongoing regular business activities, such as manufacturing and selling goods or providing a service to a customer. Now, the cash flow from investing reports how much cash has been generated or spent from various investment-related activities in a specific period. These investments, like we talked about, they include CapEx, physical assets, investments in securities, and the sale of securities or assets. The cash flow from financing is the cash flow, the net flows of cash that are used to fund the company. So it can be from debt or from equity. And then you will have the ending cash. It's the total change in the cash for the period. When added to the opening cash balance, you will know how much you have, how much cash you have. So let's look at the cash flow of Facebook, and this is their new logo. So that's their cash flow. Okay, I took it from a guy who did a wonderful analysis. I put the link of this guy. He did some analysis of not only the cash flow, but also the balance sheet and the income statement of several very known companies. So maybe it will give you also an idea. So let's talk a little bit about this cash flow. If you see that Facebook generated $38.7 billion of operating cash flow, okay, in 2020. You also can see that Facebook invested $15.1 billion in property and equipment. You can also see that the free cash flow is $23.6 billion. So when you look at the cash flow, you see where the money has gone. How much did he generate from his operation? What did he do with the money? Did he reinvest it? Yes. How much cash does he has remaining at the end? We can know from the cash flow statement. Okay, of course, you can see how much cash he has from a balance sheet, but you cannot understand the movement or how the cash has gone if you don't analyze a cash flow statement. Okay, so this is what a cash flow would look like. Sorry. Now, I have explained, I hope it was clear, income statement, balance sheet, and cash flow, and what are the elements. If you've seen, the cash flow is not something, there's not one element in the cash flow statement that you have to find or forecast, because all the elements, you have already found them in your income statement and your balance sheet, and the cash flow is a result of all those things. So now you have done your financial model, you have built it, you have put your income statement, your assumptions, your income statement, balance sheet, and cash flow. What happens? You start doing some scenario analysis. So in order to have a full view on your financials, it's important to consider different scenarios. So do I sell 5 units? Do I sell 10 units? Do I sell 20 units? So, and then because you have assumed that each unit is going to cost you that much, you need that much fixed cost, you are going to price it that much. So when you change some variables, it's going to give you a different result, and you are going to see what would be, for me, to use. I use usually 3 cases. I use the best case, I use a base case, and I use a worst case. And then I'm going to show you later what we can also do. So the best case, it's, let's start with the base case. The base case is the average scenario based on your assumption, and it should be the most realistic assumptions by being more on the conservative side. Now, the worst case, you have to do a worst case. So the worst case would be, what if, God forbid, a war broke, or the country where I'm selling my product, they cannot buy it anymore, okay? So what do? You have to put a worst case scenario. You have to know where your capital, if you have it, how you're going to lose the money. And if you lose it, then you have to put immediately a plan B. So that's why you have to look at not only a base case, but the worst case. And of course, for the investor, it's good to show them a best case. So a case where things are better than what you have been conservative. So you cannot go to an investor with just one scenario. You have to show them different scenario. And more importantly, you have to show them when you are going to break even. It means breaking even means that your profits are at zero. So in order to do so, you need to know how much you should sell to cover your direct costs and your fixed costs. So this is important because it will make you aware of your fixed costs and push you to continuously and dynamically optimize those costs. Now let's talk, this is the final slide, about common mistakes. The first common mistake is to be over-optimistic on revenue and growth rate compared to the market size. So being an entrepreneur, your duty is to make extensive market research. It's the hardest thing, but it's not something you do once and you forget about it. It's something that you continuously have to do dynamically every day. Look at the market and what is the market doing and adjust your metrics accordingly. So you have to make extensive market share in order not to overestimate or not to underestimate your revenues as well. And most importantly, not to put irrational growth rates. Not researching well data relating to expenses. So the assumptions for expenses must be real, whether it is related to direct expenses or operational expenses, because it's really, your financial model really depends on that, okay? The third common mistake is disregarding the importance of working capital. As I was talking before, a reasonable amount of cash has to be available in the business in order to run the operation smoothly and manage payment of bills as well as timely payment from clients. So if you have clients that are not paying, you are not going to have enough cash to continue your business. The other fourth common mistake is the discrepancy between your financial model and your business model. So for me, the financial model has to really reflect your vision and your mission. So when you want to put the numerical assumptions, make sure they are in line with what is your mission, how you're putting your strategy. So putting numbers is not just to put them, it's really quantifying what you are saying and seeing them in terms of numbers. And sometimes you can reverse engineer the process. You put the numbers and you stress test them on the market. Financials on a yearly basis extracted from monthly data. It is crucial when you forecast your new financial model monthly so what I'm saying here is that it's important to do it monthly, but make sure that you look at the yearly outcome. So it's not enough only to look at it monthly. It's important to look at it also on a yearly basis. And the other common mistake is spending too much time on non-material data. There's a lot of things that I did not cover in building a financial model because these are at the level of a startup, really non-material. I have covered the most important items that you need to make your decisions, okay? So when you want to optimize everything in your model to yield the best result, but take your time in optimizing the important elements and don't waste your time on unnecessary elements. And thank you.
Thank you so much, ma'am. Are we going to get the slide of this presentation?
Elvira. I think you're going to get the recording and you will have it inside. Is that okay with you?
Yes, thank you so much. Thank you. We really do appreciate it. Thank you, ma'am.
Sure. I hope it was useful. Yes, tell me, Elvira.
Actually, we will post the recording on ecomConnect in 3 days. So you can access the event section and then past event to check all the recordings, including this one.
Anyone has any questions, please? I'm ready. Okay, are there some questions online?
Yes, actually in the chat, we have a couple of questions. Deborah had a question as well.
No, I don't think it's a question. I think she was giving us a tip, if I'm not mistaken. Yeah.
So actually, anyone have a question?
Okay. Debt equity, can you explain equity? Okay. Okay. Equity is basically, mostly it's capital and it's the accumulated profit you have done. So let's start with the capital part. The capital part is what you get from investors, okay? Or what you put money in the beginning, okay? And then if your company is making profits, that accumulated profit is added to your capital and it constitutes your equity. So, and I defined also equity as being that, well, let's say you want to sell your business, you sell your assets, you pay your debt, and what remains is your equity or your owner's equity. I hope it's clear. Now, capital or funding can take different forms. So an investor can give you the money in form of just money, capital. They can give it to you as a shareholder's loan, and they can give it to you as a convertible loan. It means that they give you a loan, and then if they are happy with your performance, this is converted into equity. Okay, can you explain dilution of shares once more investors come on board? How does dilution work? Okay, so dilution, it's not about dilution. It's like when an investor comes, it is based on their perception and your perception of the value of your company. So it has nothing to do with the real numbers. Let's say you believe that you are selling 10,000 units a month, okay, and you are better than the market. So you can value your company as a multiplier of sales. Okay, so let's say you have a capital of 100,000, but the value of your company is $1 million, and this guy wants to put, let's say, $200,000. So you say, well, you can get 20% of my company with the $1 million that I have valued your company with. So the percentage, when you give percentage out of your company, it's based on the perception of the investor and your perception and some valuation that we didn't cover today. We covered it in a previous webinar that I have done when we talked about how to become investor ready. So it's very important. This is a different topic here. For an e-commerce startup, I think basically what I know today is that today VCs are more and more looking into e-commerce startups, and you have to look for those, but it depends on what stage of the investment you are in. Because if you are at the start, maybe you need angel investor, or if you need seed investment. So you have funds. I don't know from which country you are to help you, but there's a lot of funds in Africa and in the GCC interested in e-commerce today, because they believe that these are tech startups, and this is the growth in the market is in the e-commerce business going forward. Can a startup put up with all of these financial modelings for a start, or do you need to take it one at a time? So what I am saying, okay, you are from Tunisia. I know there's a lot of, there's more funds. You have to look out for the funds, VC venture capital funds that you have in Tunisia. I don't know if you've heard of Flat 6 Labs. They are an accelerator, and they have in Tunisia, and they are funding e-commerce startups. Okay, so the purpose of what I did today is to really tell you that as a startup, you need to just start putting the numbers. And I've given you a very simple one. There's a lot of templates online, a lot of them, okay? But all I'm trying to convey as a message is that you really need to start putting the information, how much you're selling, how much is the cost of sale, how much do you have employees, how much are your employees costing you, how much you're paying rent, what do you need to buy as laptops or computers? You need to put those, you need to depreciate them over 5 years. You need to see where the money is coming from, because you need to be investor ready. And part of becoming investor ready is to have your financial model. Even if it's a simple one, a mini one, that shows the investor that you know where the money is going in your business. And this is very important for the investor to know where the money is going, from where it's coming and where it's going, and how you are managing it. They have to see that you know how you're managing the money. What are the main KPIs for a VC to invest in a fashion commerce marketplace? Wow, that's a big question. That's okay. So what are the main KPIs? I can come up with those and send them to you. If you want, you can drop me an email. I'm going to put my email here for anyone who has a query like that, and I can answer you, no problem. Okay, you can find me on LinkedIn as well. My name is on LinkedIn, and I think it's in the in my bio on the ecomConnect. Did I answer all the questions? Okay, whoever would like to add me, please add me, because here it's going to be difficult to take your LinkedIn accounts. And I hope you had fun, although it was a dry subject. And please let me know if you have any more questions.
Actually, Randa, thank you for being with us today.
Thank you.
I know that the topic is not easy, but most of the SMEs are looking for it for more information. Actually, I shared your LinkedIn as well in the chat.
Okay, thank you.
So feel free, everyone, to add Randa on LinkedIn. And if you have any questions related to that, I think Randa will be glad to reply to you.
Yeah.
Thank you, Randa.
Thank you.